Hi guys, welcome back to another deep dive into one of the most devastating financial catastrophes in modern history. Tonight, we're going to take you through the complete story of the 2008 financial crisis, from its humble beginnings in the American housing market to its earth-shattering conclusion that brought the global economy to its knees. We'll explore how a seemingly stable financial system built over decades came crashing down in a matter of months, taking with it millions of jobs, trillions of dollars in wealth, and the economic security of countless families around the world. This isn't just a story about numbers and markets. It's a human story about greed, deception, regulatory failure, and the devastating consequences when financial institutions prioritize profits over responsibility. We'll walk through every crucial moment, every key player, and every decision that led to what many economists consider the worst financial disaster since the Great Depression of the 1930s. From the mortgage brokers who sold impossible dreams to families who couldn't afford them, to the Wall Street executives who packaged those dreams into toxic securities and sold them around the world, to the regulators who looked the other way while the system spiraled out of control. This is the complete, unvarnished truth about how the American dream became a global nightmare. Okay, friends, before you settle in, if you enjoy this kind of deep dive content, then click the like button and don't forget to subscribe. And yes, leave a comment letting me know where you're watching from and what time it is there. I really enjoy seeing where everyone is listening from. Now, dim the lights and turn on the fan, and let's dive into tonight's journey together, to understand how the 2008 financial crisis unfolded with such devastating precision. We need to go back to the early 2000s, when the United States was still reeling from the aftermath of the dot-com bubble burst and the September 11th terrorist attacks. The Federal Reserve, under the leadership of the legendary Alan Greenspan, had made the decision to lower interest rates to historic lows in an effort to stimulate economic growth and prevent the country from sliding into a prolonged recession. These extraordinarily low interest rates made borrowing money incredibly cheap, and nowhere was this more apparent than in the American housing market. Suddenly, people who had never been able to afford homes found themselves qualifying for mortgages they couldn't have imagined just a few years earlier. The monthly payments seemed manageable, the terms appeared reasonable, and the promise of home ownership, that cornerstone of the American dream, was finally within reach for millions of families. The housing boom that followed seemed like nothing short of a miracle for millions of Americans who had been priced out of home ownership for years. Home prices were rising steadily month after month, year after year, creating unprecedented wealth for homeowners and making real estate seem like the safest and most profitable investment possible. The common wisdom that permeated every level of society, from kitchen table conversations to boardroom discussions on Wall Street, was that housing prices never go down nationwide. They might fluctuate locally due to specific economic conditions, but the overall trend was always upward, always profitable, always secure. This belief became so deeply ingrained in American culture that it influenced everyone from individual homebuyers making the biggest financial decision of their lives to the most sophisticated financial institutions on Wall Street making billion-dollar investment decisions. Banks across the country, eager to capitalize on this unprecedented housing boom and the seemingly insatiable demand for mortgages, began systematically loosening their lending standards in ways that would have been unthinkable just a decade earlier. The traditional requirements for obtaining a mortgage, steady employment with verifiable income, a solid credit history demonstrating financial responsibility, and a substantial down payment showing serious commitment to the investment, began to seem like outdated obstacles to profit rather than prudent safeguards against risk. Lenders started offering what became known as subprime mortgages to borrowers who didn't meet conventional lending criteria, opening the doors of homeownership to people who had previously been excluded from the market. These subprime loans often came with attractive initial terms designed to make them appear affordable and manageable to borrowers who were unfamiliar with the complexities of mortgage financing. Many featured low teaser rates that would adjust upward after a few years, or interest-only payment options that allowed borrowers to pay nothing toward the principal balance for the first several years of the loan. Some loans even had negative amortization features, where the monthly payments were so low that they didn't even cover the interest charges, causing the loan balance to grow larger each month rather than smaller. The mentality driving these increasingly aggressive lending practices was elegantly simple and seemingly foolproof. Even if a borrower couldn't ultimately make their payments, the continuously rising value of their home would protect the lender from any losses. If someone defaulted on their mortgage, the bank could simply foreclose on the property and sell it for more than the original loan amount, often significantly more. This seemed like the perfect win-win situation. Borrowers got homes they otherwise couldn't afford, and lenders made substantial profits with what appeared to be minimal risk. But the story of the 2008 crisis isn't just about risky lending practices. In local communities across America, it's about how those risky loans were systematically packaged, transformed, and sold throughout the global financial system like a virus that would eventually infect every corner of the world economy. This is where the major Wall Street investment banks entered the picture, fundamentally transforming what had traditionally been a simple, local business relationship between community banks and borrowers into an incredibly complex global marketplace for mortgage-backed securities that would span continents and involve trillions of dollars. The revolutionary process that made this transformation possible was called securitization, and it would prove to be one of the most dangerous financial innovations in modern history. Instead of holding on to the mortgages they originated and maintaining a long-term relationship with borrowers, local banks began selling their mortgages to massive Wall Street investment banks, which would then bundle hundreds or even thousands of these individual mortgages together into complex securities called mortgage-backed securities, or MBS. These securities were then sold to investors around the world, from pension funds managing retirement money for millions of workers to foreign banks looking for profitable investments, to individual investors seeking steady returns for their personal portfolios. This securitization process was initially hailed as a brilliant innovation that would spread risk throughout the financial system and make it more stable and resilient. The underlying theory seemed sound and logical. By distributing mortgage risk across many different investors and institutions around the world, no single entity would be devastated if some mortgages went bad. It was financial diversification on a massive, global scale, and for several years it appeared to work exactly as intended, generating enormous profits for everyone involved, while seemingly reducing overall risk to the financial system. However, this securitization revolution created a dangerous and ultimately catastrophic disconnect between the people making critical lending decisions and the people who would ultimately bear the financial consequences of those decisions. When a local community bank kept the mortgages it originated on its own books and maintained ongoing relationships with borrowers, loan officers had powerful personal and professional incentives to make sure borrowers could actually repay their loans over the long term. Their bank's profitability and their own job security depended on making sound lending decisions. But when those mortgages were immediately packaged and sold off to distant Wall Street investment banks, the originating bank's primary concern shifted dramatically from long-term loan quality to short-term loan volume. The more mortgages they could originate and sell, regardless of the borrower's ability to repay, the more fees they could collect. This fundamental misalignment of incentives would prove to be one of the most destructive forces driving the crisis. This perverse incentive structure led to increasingly aggressive, predatory, and ultimately fraudulent lending practices that targeted the most vulnerable members of American society. Mortgage brokers, who were paid generous commissions for each loan they originated, regardless of its ultimate performance, began actively seeking out borrowers who might not fully understand the complex terms of their loans or the long-term financial implications of their decisions. They developed and aggressively marketed products with deceptive names designed to hide their true nature: ninja loans that required no income, no job, no assets verification, essentially allowing people to borrow hundreds of thousands of dollars based on nothing more than their word about their financial situation. Borrowers were routinely told they could afford homes that cost 5, 6, or even 7 times their annual income ratios that would have been considered financially suicidal just a few years earlier. Some were given adjustable rate mortgages, with initial monthly payments so artificially low that they didn't even cover the interest charges, causing their loan balances to grow larger each month rather than smaller. Others were sold interest-only loans that would require massive balloon payments after a few years, or mortgages with prepayment penalties that would trap them in unfavorable terms, even if their financial situation improved. The mortgage industry developed an entire vocabulary of euphemisms and misleading terminology designed to obscure the true nature of these increasingly questionable practices. Loans to borrowers with poor credit histories and limited ability to repay weren't called risky or dangerous. They were labeled subprime, a term that sounded technical and sophisticated rather than alarming. Mortgages that required no documentation of income, employment, or assets weren't described as fraudulent or reckless. They were marketed as stated income loans, or more colloquially, among industry insiders, liar loans. This linguistic sleight of hand helped maintain the illusion throughout the financial system that these practices represented legitimate business innovations and sophisticated risk management rather than dangerous gambles with other people's money and financial security. As the housing boom continued and accelerated through the mid-2000s, the global appetite for American mortgage-backed securities grew seemingly insatiable. Investors around the world, from European pension funds to Asian sovereign wealth funds to American insurance companies, couldn't get enough of these financial products, which appeared to offer attractive returns with minimal risk. After all, they were backed by American real estate, and the conventional wisdom that had become accepted fact was that American housing prices never went down on a national scale. To meet this enormous and growing international demand for mortgage-backed securities, Wall Street investment banks needed an ever-increasing supply of mortgages to package and securitize. This created tremendous pressure throughout the entire mortgage origination system to find new borrowers and close more loans, leading to increasingly creative, aggressive, and ultimately destructive lending practices. Some lenders began specifically targeting people who were already struggling with existing debt, offering them the opportunity to consolidate their debts into a new mortgage that would put their home at risk. Others focused their marketing efforts on minority communities and elderly borrowers, using predatory lending practices designed to extract wealth through excessive fees, unfavorable terms, and deliberately confusing contract language. The complexity and opacity of the securitization process made it virtually impossible for even sophisticated institutional investors to understand what they were actually purchasing when they bought mortgage-backed securities. A single mortgage-backed security might contain pieces of thousands of different mortgages from borrowers scattered across the entire country, representing every possible type of property, borrower, and loan terms. Even the most experienced and well-resourced institutional investors had no practical way to evaluate the creditworthiness of the underlying borrowers, the quality of the mortgage underwriting process, or the true risk characteristics of their investments. To address this fundamental information problem, the financial industry turned increasingly to credit rating agencies, supposedly independent companies, like Moody's, Investors Service, Standard & Poor's, and Fitch Ratings. These organizations were supposed to provide objective, professional assessments of the risk associated with different securities, helping investors make informed decisions about where to invest their money. Their rating systems, ranging from AAA for the safest possible investments down to junk status for the riskiest speculative securities, had been trusted by investors for decades as reliable guides to investment risk. However, the credit rating agencies faced a fundamental and ultimately devastating conflict of interest that would prove to be one of the key factors enabling the crisis. Rather than being paid by investors who relied on their ratings, the agencies were paid directly by the investment banks whose securities they were rating. This created enormous financial pressure to provide favorable ratings to complex mortgage-backed securities, regardless of the actual quality of the underlying loans or the true risks involved. The rating agencies developed increasingly sophisticated mathematical models and computer algorithms that seemed to prove scientifically that these mortgage-backed securities deserved the highest possible ratings. However, these models were based primarily on historical data about mortgage performance that didn't account for the unprecedented and dangerous changes that had occurred in mortgage lending practices. The models assumed that future mortgage performance would resemble past performance. But this assumption was fundamentally flawed when applied to loans originated under completely different standards and market conditions. The result of this flawed analysis and conflicted process was that securities backed by subprime mortgages, loans made to borrowers with poor credit histories, limited income verification, and minimal ability to repay, were routinely awarded AAA ratings, the same rating reserved for US Treasury bonds and other investments considered virtually risk-free. Pension fund managers, insurance company executives, and other fiduciaries who thought they were making conservative investments to protect their beneficiaries' money were actually purchasing pieces of an enormous bubble built on increasingly unstable foundations, as if traditional mortgage-backed securities weren't complex and risky enough. Wall Street's financial engineers invented even more exotic and dangerous instruments, designed to extract additional layers of profit from the housing boom. One of the most toxic innovations was the collateralized debt obligation, commonly known as a CDO. These were securities created by taking pieces of existing mortgage-backed securities and bundling them together into entirely new securities, creating additional layers of complexity and risk. The CDO market grew explosively during the mid-2000s, reaching hundreds of billions of dollars in total size and becoming a major source of profits for Wall Street investment banks. Some CDOs were even constructed using pieces of other CDOs, creating multiple layers of derivatives and abstraction that made it virtually impossible for anyone to understand the true underlying risks. These instruments were aggressively marketed to sophisticated institutional investors as a way to achieve portfolio diversification and attractive risk-adjusted returns. But in reality, they concentrated and amplified mortgage-related risks rather than spreading them safely throughout the financial system. Another financial innovation that would prove to be catastrophically destructive was the credit default swap, or CDs. These instruments were essentially insurance policies written on bonds, mortgages, and other securities, allowing investors to protect themselves against the possibility that their investments would lose value due to defaults or other credit events. In theory, credit default swaps seemed like a reasonable and prudent way for investors to manage and mitigate their risk exposure. But credit default swaps quickly evolved far beyond their original, seemingly innocuous purpose as insurance mechanisms. Investors and speculators began purchasing credit default swaps on securities they didn't even own, essentially placing bets that those securities would fail and their issuers would suffer losses. This created a massive parallel market where the total notional value of credit default swaps often exceeded the value of the underlying securities by factors of 10, 20, or even more. The credit default swap market operated largely in the shadows of the financial system with minimal regulation, oversight, or transparency. Unlike traditional insurance markets, there were no requirements for companies selling credit default swaps to maintain adequate reserves to pay potential claims, no standardized contract terms, and no central clearinghouse to monitor or manage counterparty risks. This meant that when mortgage-backed securities began failing en masse, many of the financial institutions that had sold credit default swaps would be completely unable to honor their contractual obligations, creating cascading failures throughout the interconnected global financial system. By 2006, careful observers were beginning to notice troubling cracks appearing in the foundation of the housing market that had seemed so solid and reliable for so many years. Home prices, which had been rising at historically unprecedented and ultimately unsustainable rates, began to level off in many major metropolitan areas across the country. For the millions of borrowers who had taken out adjustable-rate mortgages with artificially low initial payments, the financial reckoning was beginning to arrive as their monthly obligations reset to much higher levels. The standard financial advice for homeowners who found themselves in payment difficulties had always been straightforward: sell the house and move to something more affordable. This strategy had worked reliably for decades because home values generally remained stable or increased over time, ensuring that homeowners maintained equity in their properties even during economic downturns. But as housing prices stopped rising and began declining in many areas, millions of borrowers found themselves trapped in a nightmarish financial situation. These unfortunate homeowners discovered that they owed significantly more on their mortgages than their homes were currently worth, a condition that became known as being underwater or upside down on their loans. For borrowers in this desperate situation, continuing to make mortgage payments began to seem like throwing good money after bad, especially when they could rent similar properties for much less than their monthly mortgage obligations. This realization led to a wave of strategic defaults, where borrowers who actually had the financial means to continue making their mortgage payments chose to stop doing so anyway because it no longer made economic sense. Why continue paying a mortgage on a house worth $200,000 when you owe $350,000 on the loan? For many families, walking away from their homes and their mortgages became a rational financial decision. even though it meant destroying their credit ratings and abandoning communities where they had put down roots. The first major financial institution to experience the devastating effects of the deteriorating mortgage market was New Century Financial Corporation, which had been one of the largest and most aggressive subprime mortgage lenders in the entire country. In February 2007, the company announced massive losses on its mortgage portfolio and revealed that it was facing severe liquidity problems that threatened its continued existence. Within weeks, New Century Financial was forced to file for bankruptcy protection, marking the end of a company that had originated billions of dollars in subprime mortgages and had been considered a Wall Street success story just months earlier. The sudden collapse of New Century Financial sent shockwaves throughout the mortgage lending industry and served as the first clear, unmistakable warning sign that the housing boom was not just ending but potentially turning into a devastating bust. This wasn't a small, regional lender with questionable practices. This was a major national company with sophisticated management, institutional investors, and billions of dollars in capital that had simply vanished almost overnight as 2007 progressed through the spring and summer months. More and more mortgage lenders began reporting severe losses and facing existential threats. American Home Mortgage Investment Corporation, Accredited Home Lenders Holding Company, and dozens of other firms that had generated enormous profits during the housing boom suddenly found themselves completely insolvent as mortgage default rates soared beyond anything their risk models had contemplated, and the secondary market for subprime mortgages virtually disappeared. The problems that had initially seemed confined to specialized subprime mortgage lenders began spreading to the major Wall Street investment banks that had been heavily involved in securitizing and trading mortgage-related instruments. In June 2007, two hedge funds managed by Bear Stearns Companies, one of the most prestigious and well-established investment banks on Wall Street, collapsed completely due to catastrophic losses on their subprime mortgage investments. Bear Stearns had been founded in 1923 and had survived the Great Depression, World War II, numerous recessions, and every major financial crisis of the 20th century. The firm was known for its conservative culture, experienced management, and sophisticated risk management systems. If Bear Stearns could make such devastating mistakes with mortgage-related investments, it raised serious questions about the competence and judgment of Wall Street's supposedly brilliant financial minds. Initially, Bear Stearns executives tried to downplay the significance of the hedge fund failures, describing them as isolated incidents that wouldn't affect the firm's overall financial health or business operations. However, it quickly became apparent that the problems ran much deeper than anyone had initially acknowledged. The investment bank had accumulated enormous direct exposure to mortgage-backed securities, collateralized debt obligations, and other mortgage-related instruments throughout its trading operations, proprietary investment portfolios, and client service businesses, as these instruments rapidly lost value throughout the second half of 2007. Bear Stearns found itself facing an increasingly severe liquidity crisis. The firm's financial condition deteriorated so rapidly that other major financial institutions, increasingly worried about Bear Stearns' ability to honor its contractual obligations, began refusing to engage in routine business transactions with the company. This created a vicious cycle where the bank's deteriorating reputation and perceived financial weakness led to reduced access to funding, which in turn worsened its actual financial condition. The situation at Bear Stearns continued to deteriorate through the fall and winter of 2007-2008. culminating in a dramatic crisis during the second week of March 2008. Rumors about the firm's financial condition, whether accurate or not, spread rapidly through the interconnected world of Wall Street trading desks and risk management departments. Within a matter of days, Bear Stearns went from being a functioning, profitable investment bank to facing imminent bankruptcy and potential liquidation. On Friday, March 14, 2008, Bear Stearns informed federal regulators that the firm would be unable to open for business the following Monday morning unless it received emergency financial assistance. This represented an extraordinary crisis for a firm that just months earlier had been reporting profitable operations and appeared to be successfully managing the challenges posed by the deteriorating mortgage market. Federal Reserve Chairman Ben Bernanke and Treasury Secretary Henry Paulson, recognizing that the sudden, disorderly failure of a major Wall Street investment bank could trigger a broader financial panic and potentially destabilize the entire global financial system, worked frantically over the weekend to orchestrate an emergency solution. After intense negotiations involving multiple parties, they arranged for JP Chase to acquire Bear Stearns for the shockingly low price of $10 per share, a fraction of the firm's book value and a tiny percentage of what the stock had been worth just a year earlier. The Bear Stearns rescue was highly controversial because it represented an unprecedented level of government intervention in private financial markets. The Federal Reserve provided special financing arrangements to facilitate JP Morgan's acquisition, essentially using taxpayer money to prevent the failure of a private investment bank that had made catastrophically bad investment decisions. Critics argued that this intervention created a dangerous moral hazard by demonstrating that financial institutions could take enormous risks, while expecting taxpayers to bear the costs of failure. However, policymakers defended their actions as necessary to prevent a systemic financial crisis that could have caused even greater economic damage. They argued that Bear Stearns was so interconnected with other financial institutions through derivatives contracts, lending relationships, and trading arrangements that its disorderly failure could have triggered a cascade of failures throughout the financial system. The rescue of Bear Stearns temporarily stabilized financial markets and reduced immediate concerns about systemic risk. But it also sent a clear and ominous message that the crisis was far from over and might be much more severe than anyone had initially realized. If one of Wall Street's oldest and most established firms could collapse virtually overnight despite having billions of dollars in capital and decades of experience managing financial risks, then no institution was truly safe from the spreading contagion. This realization prompted a broad and frightening reassessment of risk throughout the global financial system. Investors, lenders, and counterparties began questioning the financial stability and risk management practices of every major financial institution. Credit became more expensive and harder to obtain, even for institutions that appeared to be financially sound. As everyone became more cautious about potential counterparty risks, as housing prices continued their relentless decline throughout 2008, the losses on mortgage-backed securities and related financial instruments mounted at an alarming pace across the entire global financial system. Banks, investment firms, insurance companies, and pension funds around the world began announcing massive write-downs on their holdings of these securities, often marking them down to small fractions of their original purchase prices. Financial instruments that had been considered conservative, profitable investments suitable for pension funds and insurance companies just a few years earlier were now being written off as nearly worthless. The sophisticated mathematical models that had been used to justify AAA credit ratings on these securities had proven to be spectacularly wrong, leading to hundreds of billions of dollars in unexpected losses for institutions that had trusted those models and ratings. The crisis rapidly took on a global dimension as it became clear that financial institutions around the world had invested heavily in US mortgage-backed securities, attracted by their supposedly high returns and pristine credit ratings. European banks had been particularly aggressive buyers of these instruments, viewing them as attractive alternatives to lower-yielding European government bonds. As these securities lost value, major banks from London to Frankfurt to Zurich found themselves facing severe capital shortfalls and liquidity problems. One of the most shocking and disturbing revelations of the unfolding crisis was the extent to which major financial institutions had been essentially gambling with their own survival through excessive leverage and risk-taking, rather than maintaining the conservative balance sheets and prudent risk management practices appropriate for institutions that held other people's money and served critical economic functions. Many banks and investment firms had leveraged themselves to extraordinary and ultimately unsustainable degrees. Some major investment banks had accumulated debt-to-equity ratios of 30, 40, or even 50 to 1, meaning that relatively small declines in the value of their assets could completely wipe out their entire capital base and render them insolvent. This extreme leverage had allowed these institutions to generate enormous returns on equity during the housing boom, leading to massive bonus payments for executives and traders who were rewarded based on short-term profitability rather than long-term stability. But the same financial leverage that had magnified profits during the good times now magnified losses as asset values declined, creating a death spiral that threatened the very existence of institutions that had been considered pillars of the global financial system. The executives who had earned hundreds of millions of dollars in bonuses during the boom years were now presiding over the destruction of century-old institutions and the evaporation of trillions of dollars in shareholder value. The summer of 2008 brought an increasingly rapid succession of dire developments that made clear the crisis was entering a new and more dangerous phase. Fannie Mae and Freddie Mac, the government-sponsored enterprises that had played central roles in the American mortgage market for decades, came under severe financial strain as mortgage defaults continued to mount and their losses grew to unprecedented levels. These two massive institutions, formerly known as the Federal National Mortgage Association and the Federal Home Loan Mortgage Corporation, owned or guaranteed nearly half of all outstanding mortgages in the United States, a portfolio worth trillions of dollars. Although they were technically private companies with stockholders and management teams, they had been created by acts of Congress and operated with implicit government backing that allowed them to borrow money at preferential rates. During the housing boom, Fannie Mae and Freddie Mac had dramatically expanded their operations, purchasing enormous quantities of mortgages from private lenders and either holding them in their own portfolios or packaging them into mortgage-backed securities that was sold to investors worldwide. This business model had generated substantial profits and appeared to serve the important public policy goal of making homeownership more accessible to American families. However, as mortgage defaults soared and housing prices continued to decline, both institutions faced mounting losses that threatened to overwhelm their capital reserves. Their stock prices plummeted as investors lost confidence in their ability to survive without government assistance, and their borrowing costs increased dramatically as credit markets became increasingly skeptical about their financial viability. By September 2008, It had become clear that both Fannie Mae and Freddie Mac were effectively insolvent and would require massive government intervention to continue operating. Their potential failure posed enormous risks to the broader financial system and the American economy, given their central role in mortgage finance and the trillions of dollars in obligations they had guaranteed. On September 7, 2008, the federal government took the extraordinary step of placing both Fannie Mae and Freddie Mac into conservatorship, effectively nationalizing the two companies and making the US government responsible for their obligations. This action was necessary to prevent a complete collapse of the American mortgage market, but it also represented a massive and potentially unlimited commitment of taxpayer resources to support institutions that had taken excessive risks in pursuit of profits and market share. The conservatorship of Fannie Mae and Freddie Mac marked a historic expansion of government involvement in the financial system. But it was just the beginning of what would prove to be the most tumultuous and consequential week in the history of American finance. The events that unfolded during the second week of September 2008 would fundamentally reshape the global financial system and bring the world economy to the brink of complete collapse. On Wednesday, September 10, 2008, Lehman Brothers Holdings, another venerable Wall Street investment bank with a 158-year history, reported devastating third-quarter losses of nearly $4 billion and announced that it was actively seeking a buyer or additional capital injection to avoid bankruptcy. The firm's stock price had already fallen by more than 90% from its peak just 2 years earlier, and it was becoming increasingly clear that Lehman's massive exposure to real estate and mortgage-related investments had created an existential threat to the institution's survival. Lehman Brothers had been founded in 1850 by 3 German immigrant brothers who started as cotton traders in Montgomery, Alabama, before eventually building one of Wall Street's most successful and respected investment banks. The firm had played important roles in financing American economic growth for more than a century, helping to fund railroads, steel companies, retail chains, and countless other businesses that have built the modern American economy. However, during the housing boom of the 2000s, Lehman had become one of the most aggressive players in real estate and mortgage-related investments. The firm had accumulated enormous positions in commercial real estate, residential mortgages, and complex derivatives tied to property values. As real estate markets deteriorated, these positions generated catastrophic losses that overwhelmed the firm's capital base and destroyed investor confidence. Over the weekend of September 13th to 14th, 2008, government officials, Wall Street executives, and potential acquirers worked around the clock in desperate attempts to find a solution that would prevent Lehman Brothers from filing for bankruptcy. The Federal Reserve Bank of New York hosted marathon negotiating sessions involving dozens of the most powerful people in American finance, all trying to craft a deal that would save the failing investment bank and prevent broader systemic damage. Bank of America initially emerged as the most likely buyer for Lehman Brothers, but the Charlotte-based bank ultimately decided that Lehman's potential losses were too large and unpredictable to justify the acquisition. Instead, Bank of America chose to pursue the acquisition of Merrill Lynch, another troubled investment bank that was facing similar but less severe problems. Barclays, the large British bank, also conducted extensive due diligence on a potential Lehman acquisition throughout the weekend, but ultimately concluded that it could not complete such a complex transaction quickly enough to prevent Lehman's collapse. British regulatory authorities also expressed concerns about allowing a British bank to acquire an American investment bank that was facing such enormous and uncertain liabilities. As Sunday evening approached and financial markets prepared to open in Asia, it became painfully clear that no private sector solution would be found for Lehman Brothers. Unlike the Bear Stearns situation 6 months earlier, government officials made the fateful decision not to provide public funds to facilitate a rescue of the failing investment bank. This decision reflected a combination of political, economic, and practical considerations. The Bear Stearns rescue had been heavily criticized by members of Congress and the general public, who argued that taxpayers should not be responsible for bailing out firms that had made reckless investment decisions. Treasury Secretary Paulson and other officials were also concerned about establishing a precedent that would encourage other financial institutions to take excessive risks while expecting government protection from the consequences. On Monday morning, September 15, 2008, Lehman Brothers Holdings filed for Chapter 11 bankruptcy protection, officially becoming the largest bankruptcy in United States history, with more than $600 billion in assets and $613 billion in debt. The filing marked the end of one of Wall Street's most storied institutions and sent immediate shockwaves through global financial markets that would reverberate for years to come. The bankruptcy of Lehman Brothers had immediate and catastrophic consequences that extended far beyond the firm itself. Lehman had been a major participant in virtually every corner of the global financial system, from corporate bond underwriting to derivatives trading to foreign exchange markets. The firm's sudden disappearance left enormous gaps in these markets and created panic among investors who began frantically trying to assess which institution might be the next to fail. One of the most serious and immediate consequences of Lehman's bankruptcy was the severe damage it inflicted on money market mutual funds, which millions of Americans had come to rely upon as safe alternatives to traditional bank savings accounts. These funds invested in short-term, supposedly low-risk securities and had maintained stable net asset values of exactly $1 per share for decades, earning them a reputation as virtually risk-free investments. However, the Reserve Primary Fund, one of the oldest and largest money market funds in the country, had invested heavily in Lehman Brothers commercial paper and other short-term debt instruments. When Lehman filed for bankruptcy, these investments became essentially worthless overnight, forcing the Reserve Primary Fund to announce that its net asset value had fallen below $1 per share, a condition known as breaking the buck. That had almost never occurred in the history of money market funds. The news that a major money market fund had lost money sent waves of panic throughout this supposedly ultra-safe corner of the financial system. Individual and institutional investors began withdrawing money from money market funds en masse, forcing these funds to sell their holdings rapidly to meet redemption demands. This created severe disruption in the short-term funding markets that many businesses relied upon for their day-to-day operations, including payroll financing, inventory purchases, and other routine commercial activities. On the same day that Lehman Brothers filed for bankruptcy, Bank of America announced that it had agreed to acquire Merrill Lynch and Company, another major Wall Street investment bank that had been severely damaged by mortgage-related losses, but had managed to find a buyer before its situation became as desperate as Lehman. The acquisition price of $50 billion represented a substantial premium to Merrill's recent trading price, but it was still far below the firm's value just 2 years earlier. Merrill Lynch, founded in 1914 and known for bringing Wall Street to Main Street through its large network of financial advisors, had been one of the most respected names in American finance. The firm's famous slogan, Merrill Lynch is bullish on America had symbolized optimism and confidence in American economic growth for generations of investors. However, like so many other Wall Street firms, Merrill had accumulated dangerous levels of exposure to mortgage-backed securities and collateralized debt obligations that generated enormous losses as real estate markets collapsed. The emergency sale of Merrill Lynch to Bank of America highlighted how rapidly the crisis was forcing consolidation throughout the financial services industry. Firms that had competed fiercely for decades were now being forced into hasty marriages of necessity, fundamentally reshaping the competitive landscape of American finance. The day after Lehman's bankruptcy filing, attention turned to American International Group, commonly known as AIG, one of the world's largest and most systemically important insurance companies. AIG had not been a major player in mortgage origination or real estate development, but it had become deeply and dangerously involved in the crisis through its massive sales of credit default swaps on mortgage-backed securities and collateralized debt obligations. Through its financial products division, AIG had essentially become one of the world's largest sellers of insurance on mortgage-related securities, collecting billions of dollars in premiums from financial institutions around the globe that wanted to protect themselves against potential losses on their mortgage investments. This business had appeared to be highly profitable and relatively low risk, as AIG's sophisticated models suggested that widespread mortgage defaults were extremely unlikely. However, as mortgage-related securities began failing en masse throughout 2008, AIG faced enormous and rapidly growing claims on the credit default swaps it had sold. The company had collected the premium payments and reported them as profits, but it had not set aside adequate reserves to pay the massive claims that were now coming due. Worse still, the contracts AIG had signed required the company to post additional collateral as the value of the underlying securities declined, creating a cash drain that accelerated as markets deteriorated. AIG's situation was particularly dangerous for the broader financial system because of the company's extraordinary interconnectedness with virtually every major financial institution in the world. Banks, insurance companies, pension funds, and other institutions across the globe had purchased credit default swaps from AIG as protection against losses on their mortgage-related investments. If AIG failed, these institutions would not only lose the protection they thought they had purchased, but they would also face additional direct losses on their AIG investments and counterparty exposures. Recognizing that AIG's failure could trigger an immediate cascade of failures throughout the interconnected global financial system, Federal Reserve Chairman Ben Bernanke and Treasury Secretary Henry Paulson made the unprecedented decision to provide emergency government assistance to keep the insurance giant operational. On September 16, 2008, just one day after allowing Lehman Brothers to fail, the Federal Reserve announced an emergency loan facility that would provide AIG with up to $85 billion in funding in exchange for an 99.9% ownership stake in the company. This AIG bailout represented the largest government rescue of a private company in American history up to that point. And it was deeply controversial precisely because it came so soon after the government had allowed Lehman Brothers to collapse. Critics argued that the decision to save AIG while letting Lehman fail was arbitrary and unfair, rewarding one company that had made catastrophically bad decisions while punishing another for similar mistakes. The inconsistency of the government's approach created enormous uncertainty in financial markets about which institutions would be saved and which would be allowed to fail. However, Policymakers defended the AIG rescue by arguing that the insurance company's failure would have caused immediate and catastrophic damage to the global financial system that would have dwarfed the problems caused by Lehman's bankruptcy. AIG's credit default swap obligations created direct counterparty relationships with virtually every major bank in the world, meaning that its failure would have immediately triggered massive losses at institutions that were already under severe stress. As news of Lehman's bankruptcy and AIG's near collapse spread around the world, panic gripped financial markets on a scale not seen since the Great Depression. Stock markets plummeted as investors fled to the perceived safety of government bonds and cash, with major indices falling by unprecedented amounts in single trading sessions. The Dow Jones Industrial Average experienced several of its largest single-day point declines in history during the weeks following Lehman's failure. Banks became increasingly reluctant to lend money to each other, even for overnight periods, as institutions hoarded cash and became suspicious of every potential counterparty's financial stability. Interest rates in interbank lending markets spiked to crisis levels, and the normal functioning of credit markets that businesses depend on for routine operations began to break down completely. The credit freeze that developed in the aftermath of Lehman's bankruptcy threatened to bring normal economic activity to a grinding halt. Companies that had been able to borrow money easily to finance payrolls, purchase inventory, and fund other routine operations suddenly found themselves unable to access credit at any price. This liquidity crisis meant that even profitable, well-managed businesses faced the possibility of bankruptcy simply because they couldn't obtain the short-term financing they needed to operate. The spreading financial panic quickly reached beyond Wall Street to affect Main Street banks and ordinary consumers across the country. Washington Mutual, one of the largest savings and loan associations in the United States, experienced a classic bank run as depositors lost confidence in the institution's ability to survive the crisis. Within a matter of days, the bank lost more than $16 billion in deposits. As frightened customers rushed to withdraw their money. Washington Mutual had grown rapidly during the housing boom by offering aggressive mortgage products and expanding into new markets through acquisitions. The bank had originated billions of dollars in subprime and Alta mortgages, many of which were now in default as housing prices fell and borrowers found themselves unable to make payments. As losses mounted and depositors fled, the bank's financial condition deteriorated with stunning speed. On September 25, 2008, Washington Mutual was seized by the Office of Thrift Supervision in what became the largest bank failure in United States history. The bank was immediately sold to JP Morgan Chase for the bargain price of $1.9 billion. A fraction of what the institution had been worth just months earlier. With more than $300 billion in assets and 2,200 branch locations across the country, Washington Mutual's failure demonstrated how quickly even large, established institutions could be brought down by the spreading crisis. The failure of Washington Mutual was followed within days by the near collapse of Wachovia Corporation, another major bank that had made significant investments in mortgage-related securities and aggressive loans during the housing boom. Wachovia's stock price plummeted as investors lost confidence in the bank's ability to absorb its mounting losses, and the institution was forced to seek an emergency merger to avoid the same fate as Washington Mutual. The Wachovia situation created a dramatic bidding war between two potential acquirers. Citigroup initially agreed to purchase Wachovia's banking operations with government assistance, but Wells Fargo quickly made a competing offer to acquire the entire company without government support. After several days of legal battles and negotiations, Wells Fargo's bid ultimately prevailed, creating one of the largest banks in the United States and further consolidating the American banking industry. These rapid-fire bank failures and emergency mergers illustrated how the crisis was forcing unprecedented consolidation throughout the financial services industry. Institutions that had competed with each other for decades were being forced into marriages of necessity, creating larger and potentially more systemically important banks that would be even more difficult to allow to fail in future crises. As the crisis deepened and spread throughout September 2008, it became increasingly clear that ad hoc interventions to save individual institutions would not be sufficient to restore stability to the financial system. The problems were too widespread, too interconnected, and too severe for piecemeal solutions to be effective. What was needed was a comprehensive, systematic approach to address the fundamental problems plaguing the entire financial system. On September 19, 2008, Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke made an extraordinary and unprecedented request to the United States Congress. They asked for legislative authority to spend up to $700 billion of taxpayer money to purchase troubled assets from financial institutions across the country. This proposal, which became known as the Troubled Asset Relief Program, or TARP, represented one of the largest government interventions in the private economy in American history. The original TARP proposal was remarkably brief and gave the Treasury Department extraordinarily broad discretion to determine which assets to purchase from which institutions and at what prices. Paulson argued that this flexibility was essential to allow the government to respond quickly and effectively to rapidly changing market conditions. But many members of Congress were deeply uncomfortable with granting such sweeping authority. With so little oversight or accountability, the TARP proposal triggered intense political debate that reflected broader public anger about the idea of using taxpayer money to rescue Wall Street firms that had caused the crisis through their own reckless and greedy behavior. Many Americans were outraged by the prospect of socializing the losses of private financial institutions while allowing their executives to retain the enormous profits and bonuses they had earned during the boom years. Congressional phone lines were flooded with calls from constituents expressing overwhelming opposition to the bank bailout plan. Many Americans felt that Wall Street executives who had caused the crisis should face personal consequences for their actions, rather than being rescued by the taxpayers whose economic security they had destroyed. The idea of rewarding failure while punishing those who had played by the rules seemed fundamentally unfair and contrary to basic principles of capitalism and personal responsibility. The initial TARP proposal was rejected by the House of Representatives on September 29, 2008, by a vote of 228 to 205, with opposition coming from both Republican members who objected to massive government intervention in private markets and Democratic members who demanded stronger protections for taxpayers and homeowners facing foreclosure. The defeat of the bailout plan sent stock markets into absolute free fall, with the Dow Jones Industrial Average plummeting by more than 777 points in a single day, the largest single-day point decline in the index's history up to that time. The market's violent reaction to the defeat of TARP made clear that investors viewed government intervention as absolutely essential to preventing a complete collapse of the financial system. The massive sell-off wiped out more than $1 trillion in stock market value in a single day, demonstrating the enormous stakes involved in the congressional debate over the bailout plan. Faced with this market reaction and intense pressure from business leaders, foreign governments, and financial institutions around the world, Congress reconsidered the TARP proposal over the following days. After intense negotiations that included additional taxpayer protections, limits on executive compensation, and oversight mechanisms, a modified version of the plan was passed by the Senate on October 1st and by the House on October 3rd, 2008. However, the passage of TARP did not immediately calm financial markets or restore confidence in the banking system. Investors remained deeply concerned about the health of major financial institutions and the broader economy, and bank stocks continued to decline precipitously as investors worried about which institutions might be next to fail. The credit markets remained largely frozen, with banks continuing to hoard cash rather than lending to each other or to businesses and consumers. The crisis reached new levels of intensity in early October 2008, as it became clear that the problems in the United States financial system were spreading rapidly to other countries around the world. European banks, many of which had invested heavily in US mortgage-backed securities during the boom years, began reporting massive losses and seeking government assistance from their home countries. The interconnected nature of global financial markets meant that problems that had started with American subprime mortgages quickly spread to financial institutions on every continent. European banks had been particularly aggressive buyers of American mortgage-backed securities, attracted by their high yields and AAA credit ratings. As these securities lost value, major European institutions found themselves facing the same kinds of capital shortfalls and liquidity problems that were plaguing American banks. In Iceland, the crisis took on particularly dramatic dimensions as the country's entire banking system collapsed virtually overnight. Iceland's three largest banks, Kaupthing, Landsbanki, and Glitnir, had grown to enormous size relative to the small island nation's economy, with combined assets that were more than 10 times larger than Iceland's entire gross domestic product. These banks had expanded aggressively into international markets and had accumulated significant exposure to mortgage-backed securities and other risky investments. When the global credit crisis hit, Iceland's banks found themselves unable to roll over their short-term funding, and the Icelandic government discovered that it lacked the resources to support financial institutions that had grown far beyond the capacity of the small country's fiscal resources. All three major banks were nationalized within a matter of days in early October 2008, and Iceland was forced to seek emergency assistance from the International Monetary Fund, the first Western European country to do so since the 1970s. The Icelandic banking crisis was particularly dramatic due to the small size of the country and the extreme degree to which its banks had grown beyond any reasonable relationship to the domestic economy. However, similar problems were emerging throughout Europe as banks in the United Kingdom, Germany, France, Switzerland, and other countries reported massive losses and sought government assistance. In the United Kingdom, Royal Bank of Scotland, which had been one of the world's largest banks by assets, faced near collapse due to its exposure to mortgage-backed securities and its ill-timed acquisition of Dutch bank ABN AMRO at the peak of the market. The British government was forced to inject billions of pounds of capital into RBS and several other major banks to prevent their failure. Northern Rock, a British bank that had relied heavily on short-term funding markets rather than traditional deposits, experienced the United Kingdom's first bank run in more than a century as depositors queued for hours outside branch locations to withdraw their money. The British government eventually nationalized Northern Rock to prevent its complete collapse in Germany. The government was forced to arrange emergency rescues for several major banks, including Hypo Real Estate, which had significant exposure to American mortgage markets. The German government also took the unprecedented step of guaranteeing all private bank deposits to prevent widespread bank runs. The global nature of the crisis reflected the deep interconnectedness of modern financial markets and the extent to which mortgage loans originated in places like California, Florida, and Nevada had been securitized by Wall Street investment banks and sold to investors around the world. When those mortgages began defaulting en masse, the losses were felt. From New York to London to Frankfurt to Tokyo and beyond. Central banks around the world recognized that the crisis required coordinated international action and began working together to provide liquidity to the global financial system. On October 8, 2008, the Federal Reserve joined with the European Central Bank, the Bank of England, the Bank of Canada, the Bank of Japan, and the Swiss National Bank in a coordinated interest rate cut designed to provide immediate relief to credit markets. This coordinated action represented an unprecedented level of cooperation among the world's major central banks. But even these dramatic measures were insufficient to restore confidence to financial markets. Stock markets around the world continued to experience extreme volatility, with major indices suffering some of their worst single-day declines in decades as investors struggled to assess the magnitude of the crisis and its potential impact on the global economy. The banking system remained under severe stress throughout October 2008, as institutions continued to hoard cash and became increasingly reluctant to lend to each other or to businesses and consumers. This credit contraction began to have serious effects on the real economy, as businesses found it increasingly difficult to obtain the financing they needed for normal operations, such as meeting payroll, purchasing inventory, and investing in new equipment. Recognizing that the original TARP approach of purchasing troubled assets from banks would be too slow and complex to implement effectively in the midst of a rapidly evolving crisis, Treasury Secretary Paulson announced a significant change in strategy in mid-October 2008. Instead of buying troubled assets, the government would use TARP funds to make direct capital investments in banks by purchasing preferred shares in major financial institutions. This approach was designed to strengthen bank balance sheets more quickly and directly than asset purchases would have accomplished. By injecting capital directly into banks, the government could immediately improve their ability to absorb losses and continue lending, rather than waiting for the complex and time-consuming process of valuing and purchasing troubled assets. The first round of capital injections under the revised TARP program went to 9 of the largest banks in the United States, including Citigroup, Bank of America, JP Morgan Chase, Wells Fargo, Goldman Sachs, Morgan Stanley, Merrill Lynch, and Washington Mutual's successor operations. The government invested a total of $125 billion in these institutions in exchange for preferred shares that would pay dividends and could potentially be converted to common stock. The decision to make direct investments in banks was controversial because it meant that the United States government would become a significant shareholder in major private financial institutions. Critics argued that this represented an inappropriate level of government involvement in the private sector and could lead to political interference in business decisions. Supporters maintained that extraordinary circumstances required extraordinary measures and that direct capital injection was the most effective way to stabilize the banking system. Even with government capital injections, the banking system remained under severe strain. Throughout the remainder of 2008 and into early 2009, Many banks continued to report massive losses on their mortgage-related investments, and the broader economic outlook continued to deteriorate as unemployment rose and consumer spending declined. The financial crisis had begun to have profound effects on the real economy by late 2008, extending far beyond the banks and Wall Street, firms that had been at the center of the initial turmoil. Unemployment was rising rapidly as businesses laid off workers in response to declining demand, tightening credit conditions, and general economic uncertainty. The national unemployment rate, which had been around 5% at the beginning of 2008, would eventually peak at more than 10% in late 2009. The housing market, which had been the original source of the crisis, continued to deteriorate. As foreclosures mounted and home prices fell in virtually every region of the country, millions of American families found themselves trapped in homes worth less than their mortgage balances, while millions more lost their homes entirely to foreclosure proceedings. The human cost of the crisis was becoming increasingly apparent, as entire neighborhoods were devastated by abandoned properties and falling home values. Consumer spending, which had been a key driver of American economic growth for decades, began to decline sharply as households faced falling home values, rising unemployment, and much tighter credit conditions. The decline in consumer spending created a vicious cycle as businesses responded to reduced demand by cutting jobs and reducing investment, which further weakened the economy and reduced consumer confidence. The automotive industry was hit particularly hard by the combination of tight credit and reduced consumer demand. General Motors and Chrysler, already struggling with high labor costs, legacy pension obligations, and intense competition from foreign manufacturers, found themselves facing potential bankruptcy as credit markets froze and vehicle sales plummeted, two levels not seen in decades. The crisis in the automotive industry had implications that extended far beyond the car companies themselves. The domestic auto industry supported millions of jobs, not only in manufacturing plants, but also in dealerships, parts suppliers, and related service industries scattered across the country. The potential collapse of General Motors and Chrysler threatened to devastate entire communities in the Midwest that had built their economies around automotive manufacturing. In November 2008, executives from General Motors, Ford, and Chrysler traveled to Washington to request emergency government assistance to avoid bankruptcy. Their initial request was met with skepticism and even ridicule from members of Congress, particularly after it was revealed that the executives had traveled to Washington on private corporate jets while asking for taxpayer bailouts. The debate over automotive industry assistance reflected broader questions about the appropriate role of government in rescuing private companies that had made poor business decisions over many years. Critics argued that allowing these companies to fail would force necessary restructuring and allow more efficient competitors to gain market share. They contended that government intervention would only delay inevitable changes and reward companies for their past mistakes. Supporters of automotive industry assistance argued that the collapse of General Motors and Chrysler would have devastating effects on employment and economic activity in many communities across the Midwest and beyond. They maintained that the extraordinary circumstances of the financial crisis justified government intervention to prevent even greater economic damage. As 2008 drew to a close, it was clear that the financial crisis had evolved into the most severe economic recession since the Great Depression of the 1930s. The National Bureau of Economic Research, the official arbiter of American business cycles, would later determine that the recession had actually begun in December 2007, making it both the longest and deepest economic downturn since World War II. The human cost of the crisis was staggering and continued to mount as the recession deepened. Millions of Americans had lost their homes to foreclosure, with particularly severe impacts on minority communities that had been disproportionately targeted by predatory lenders during the housing boom. African American and Hispanic families, who had made significant gains in home ownership during the 1990s and early 2000s, saw much of that progress wiped out by the crisis. Unemployment was rising rapidly across all sectors of the economy and all demographic groups, reaching levels not seen since the early 1980s recession. The unemployment rate for recent college graduates was particularly troubling, as young people entering the job market found themselves competing for a shrinking number of entry-level positions while carrying record levels of student loan debt. The wealth destruction caused by the crisis was truly unprecedented in modern American history. Trillions of dollars in stock market value had been wiped out as major indices fell by more than 50% from their peak levels. Home values had declined by trillions more, destroying the primary source of wealth for millions of middle-class American families. Retirement accounts that had taken decades to build were decimated almost overnight, forcing many older Americans to delay retirement plans or return to work after losing much of their accumulated savings. The crisis was particularly cruel to those who were nearing retirement when it hit, as they had little time to recover their losses before needing to begin drawing on their retirement accounts. The crisis also had severe impacts on state and local governments across the country, which saw their tax revenues decline sharply as economic activity contracted and property values fell. Many states were forced to make deep cuts to essential services like education, healthcare, and public safety, further amplifying the economic damage and human suffering caused by the crisis. Educational institutions at all levels felt the impact of the crisis as state funding declined and endowments lost value. Public universities were forced to raise tuition and reduce course offerings, while many private colleges struggled to maintain their financial aid programs as their endowments shrank. The crisis accelerated existing trends toward higher student debt levels and reduced access to higher education for low-income students. As Barack Obama prepared to take office as the 44th President of the United States in January 2009, he inherited an economy in freefall and a financial system that remained severely damaged despite the various rescue efforts that had been implemented. The new administration would face the enormous challenge of implementing additional measures to stabilize the financial system, prevent further economic deterioration, and begin the long process of recovery. The early months of 2009 brought additional stress tests for the financial system as several major banks, including Citigroup and Bank of America, required additional government assistance beyond what they had already received through the initial TARP capital injections. The government's involvement in the banking system deepened significantly as it became clear that the initial interventions had not been sufficient to restore financial stability. Citigroup, once the largest bank in the world, was facing particularly severe problems due to its massive exposure to mortgage-related securities and its global operations in countries that were also experiencing financial difficulties. The bank received multiple rounds of government assistance, including capital injections, asset guarantees, and other forms of support that eventually gave the government a controlling stake in the institution. Bank of America was struggling to digest its emergency acquisition of Merrill Lynch, which had brought significant additional mortgage-related losses onto the bank's balance sheet. The bank also faced potential losses from its acquisition of Countrywide Financial, one of the largest subprime mortgage lenders during the housing boom. Like Citigroup, Bank of America required multiple rounds of government assistance to remain viable. In February 2009, the Obama administration announced the Financial Stability Plan, a comprehensive approach to addressing the multiple dimensions of the ongoing financial crisis. The plan included additional capital for banks, expanded programs to modify mortgages for homeowners facing foreclosure, and the creation of public-private partnerships designed to remove troubled assets from bank balance sheets. The Financial Stability Plan represented a significant evolution from the initial TARP approach, incorporating lessons learned from the previous months of crisis management and addressing some of the criticism that had been directed at the government's response. However, the plan was still controversial, particularly among members of Congress and the general public who remained opposed to using taxpayer money to rescue financial institutions, one of the most controversial aspects of the government's crisis response was the revelation that companies receiving taxpayer assistance were continuing to pay substantial bonuses to their executives and employees. The most egregious example was American International Group, which paid more than $165 million in bonuses to employees in the same financial products division that had nearly caused the company's collapse through its reckless credit default swap activities. The AIG bonus controversy sparked widespread public outrage and congressional investigations, highlighting the broader anger that many Americans felt about the perceived unfairness of the government's crisis response. Many citizens felt that Wall Street executives who had caused the crisis were being rewarded while ordinary Americans who had played by the rules were suffering the consequences through job losses, foreclosures, and reduced retirement savings. The bonus payments also raised important questions about the government's ability to impose conditions on companies receiving taxpayer assistance. Critics argued that if the government was going to rescue these institutions, it should have the authority to prevent them from making payments that seemed to reward the very behavior that had caused the crisis in the first place. As the crisis continued to unfold through the first half of 2009, regulatory authorities began conducting comprehensive stress tests on the largest banks to determine their ability to withstand additional economic deterioration. These tests, officially known as the Supervisory Capital Assessment Program, were designed to restore confidence in the banking system by providing transparency about the true financial condition of major institutions. The stress tests evaluated how banks would perform under adverse economic scenarios that included further declines in housing prices, higher unemployment rates, and continued economic contraction. The results, released in May 2009, revealed that 10 of the 19 largest banks would need to raise additional capital totaling $75 billion to maintain adequate capital levels under the stress scenarios. Some banks were able to raise the required capital from private investors, demonstrating that the crisis of confidence in the banking system was beginning to ease. Others required additional government assistance or were forced to significantly reduce their risk profiles and business activities. The stress test process helped restore some measure of confidence in the banking system by providing investors and depositors with clearer information about which institutions were financially sound. The financial crisis also prompted significant changes in the structure and competitive landscape of the American financial services industry. Several major investment banks either failed, were acquired by commercial banks, or converted to bank holding companies to gain access to federal deposit insurance and Federal Reserve lending facilities. The era of large, independent investment banks that had dominated Wall Street for decades effectively came to an end. Goldman Sachs and Morgan Stanley, the last two major independent investment banks, both converted to bank holding companies in September 2008 to gain access to more stable funding sources and Federal Reserve support during the crisis. This conversion subjected them to greater regulatory oversight and capital requirements, but it also provided them with access to deposits and Federal Reserve lending that proved crucial to their survival. The consolidation that occurred during the crisis created a financial services industry dominated by an even smaller number of very large institutions. JP Morgan Chase emerged from the crisis significantly larger after acquiring Bear Stearns and Washington Mutual, while Bank of America expanded through its acquisitions of Countrywide Financial and Merrill Lynch. Wells Fargo became one of the largest banks in the country through its acquisition of Wachovia. This consolidation raised important questions about competition and systemic risk in the financial system. The largest banks had become even larger and more systemically important, potentially making the too big to fail problem worse rather than better. Critics argued that the crisis response had rewarded the largest institutions at the expense of smaller competitors and had created even greater moral hazard for future risk-taking. The process of economic recovery from the 2008 financial crisis proved to be extraordinarily long and difficult. Unlike previous recessions that had typically been relatively short-lived affairs, followed by robust rebounds, the official recession ended in June 2009, according to the National Bureau of Economic Research. But unemployment remained stubbornly high for years afterward, not returning to pre-crisis levels until 2016. The slow pace of recovery reflected the severity of the financial damage that had occurred during the crisis and the time required for the financial system to heal and resume normal functioning. When banks and other financial institutions suffer severe damage to their balance sheets, it takes considerable time for them to rebuild their capital bases, restore confidence, and resume normal lending activities. This process of created persistent headwinds for economic growth that lasted for years after the acute phase of the crisis had ended. The crisis fundamentally changed the relationship between the government and the financial system in ways that continue to influence policy debates today. The massive scale of government intervention during the crisis, including bank bailouts, stimulus spending, and unprecedented monetary policy measures, demonstrated both the government's capacity to respond to systemic crises and the enormous costs of such interventions. The Dodd-Frank Wall Street Reform and Consumer Protection Act, signed into law in July 2010, represented the most comprehensive overhaul of financial regulation since the New Deal era of the 1930s. The legislation created new regulatory agencies, imposed stricter capital requirements on banks, established new oversight mechanisms for systemically important institutions, and created new rules governing derivatives, markets, and other previously unregulated areas of finance. One of the key provisions of Dodd-Frank was the Volcker Rule, named after former Federal Reserve Chairman Paul Volcker, which restricted banks from engaging in proprietary trading, essentially gambling with their own money in financial markets rather than serving customers. The rule was designed to prevent banks from taking the kinds of excessive risks that had contributed to the 2008 crisis, while still allowing them to provide essential banking services. The legislation also created the Consumer Financial Protection Bureau, a new federal agency specifically focused on protecting consumers from predatory lending and other abusive financial practices. The CFPB was given broad authority to regulate mortgages, credit cards, student loans, and other consumer financial products, representing a significant expansion of federal consumer protection efforts. Despite these regulatory changes, debates continue about whether the financial system is truly safer today than it was before the 2008 crisis. Some critics argue that the largest banks have actually grown even larger and more systemically important through the consolidation that occurred during and after the crisis, making the too big to fail problem worse rather than better. Others point out that while new regulations have been implemented, many of the fundamental incentive problems that contributed to the crisis remain unresolved. Executive compensation at major financial institutions is still largely tied to short-term performance measures that may encourage excessive risk-taking, and the originate-to-distribute model of mortgage lending that played such a central role in the crisis continues to operate in modified form. The international dimensions of the crisis also led to significant efforts to strengthen global financial regulation and coordination among regulators in different countries. The Basel III international banking regulations imposed higher capital requirements on banks worldwide and established new standards for bank liquidity and leverage ratios. The Financial Stability Board, an international organization that coordinates financial regulation across countries, was strengthened and given a broader mandate to monitor systemic risks in the global financial system. However, achieving effective international coordination remains challenging, as different countries have different regulatory philosophies and competing economic interests. Central banks around the world also learned important lessons from the crisis about the need to pay attention to financial stability concerns in addition to their traditional focus on price stability and employment. Many central banks expanded their mandates to include explicit responsibility for monitoring and addressing systemic risks in the financial system. The Federal Reserve and other major central banks also adopted unconventional monetary policies in response to the crisis, including quantitative easing programs that involved purchasing large quantities of government bonds and other securities to inject liquidity into the financial system. These policies were controversial but were seen as necessary given the severity of the economic downturn and the constraint that short-term interest rates were already near zero. The human impact of the 2008 financial crisis extended far beyond the immediate economic damage and continued to affect millions of families for years after the acute phase of the crisis had ended. The foreclosure crisis displaced millions of American families from their homes, with particularly severe effects on communities of color that had been disproportionately targeted by predatory lenders during the housing boom. The psychological trauma of losing one's home, particularly for families who had believed they were achieving the American dream of home ownership, was profound and lasting. Many families lost not only their homes, but also their life savings, their good credit ratings, and their faith in the financial system and the American economy more broadly. The crisis also exposed and exacerbated existing inequalities in American society along lines of race, class, and geography. Minority communities that had been targeted by subprime lenders suffered disproportionate losses when the housing bubble burst, widening wealth gaps that had been slowly narrowing in previous decades. Rural and Rust Belt communities that had already been struggling with economic decline were hit particularly hard by the recession that followed the financial crisis. Young adults who were entering the job market during and after the crisis faced particularly difficult circumstances that would affect their career prospects and lifetime earnings for years to come. Many college graduates found themselves unable to find employment commensurate with their education and skills, leading to what economists have called a lost generation of workers whose careers were permanently damaged by the timing of their entry into the labor market. The crisis also had lasting effects on American attitudes toward home ownership, debt, and financial institutions. The cultural belief that home ownership was always a good investment and a reliable path to building wealth was severely shaken by the experience of millions of families who lost money on their homes. Credit became much tighter after the crisis, as both lenders and borrowers became more cautious about taking on debt. Trust in financial institutions, which had been declining gradually for years before the crisis, fell to historic lows and has never fully recovered. Surveys consistently show that Americans have much less confidence in banks, Wall Street firms, and financial regulators than they did before the crisis. This erosion of trust has had significant political and economic consequences, contributing to increased support for populist politicians and policies across the political spectrum. The crisis also had significant political ramifications that continue to influence American politics today. The bank bailouts, while arguably necessary to prevent even greater economic damage, created lasting resentment among many Americans who felt that Wall Street had been rescued while Main Street was left to suffer. This anger contributed to the rise of populist political movements on both the left and right of the political spectrum. The Tea Party movement, which emerged in 2009, was motivated partly by opposition to the bank bailouts and the expansion of government involvement in the economy. Similarly, the Occupy Wall Street movement that began in 2011 reflected widespread anger about economic inequality and the perceived impunity of financial institutions that had caused the crisis but faced few consequences for their actions. The crisis also had profound effects on economic thinking and policy debates that continue to influence academic research and policy discussions today. The mainstream economic models that had dominated academic and policy circles before 2008 had largely failed to predict or explain the severity of the financial crisis, leading to significant soul-searching within the economics profession about the adequacy of existing theoretical frameworks. Many economists began to pay much more attention to the role of behavioral factors in financial markets, recognizing that the assumptions of perfect rationality that underpinned many economic models were inadequate for understanding how markets actually function during times of stress and uncertainty. The field of behavioral economics, which had been relatively marginal before the crisis, gained much greater prominence in academic and policy circles. The crisis also highlighted the critical importance of understanding interconnections and systemic risks in the financial system rather than analyzing different institutions and markets in isolation. Traditional economic models had often treated different parts of the financial system as independent, but the 2008 crisis demonstrated how problems in one area could quickly spread throughout the entire system through various channels of contagion. This recognition led to greater emphasis on macroprudential regulation policies designed to address systemic risks and the stability of the financial system as a whole, rather than just the safety and soundness of individual institutions. Regulators began developing new tools and frameworks for monitoring systemic risk and intervening to prevent the buildup of dangerous imbalances. The crisis also accelerated existing trends toward the use of technology in financial services as entrepreneurs saw opportunities to improve upon traditional financial institutions that had failed so spectacularly. Online lending platforms, mobile payment systems, digital currencies, and other financial technology innovations gained traction partly as a result of reduced trust in traditional banks and financial intermediaries, the development of cryptocurrency and blockchain technology, while not direct responses to the 2008 crisis, gained popularity partly due to their promise of creating financial systems that would be less dependent on traditional banks and government oversight. The first Bitcoin transaction occurred in January 2009, just months after the height of the financial crisis, and the technology's early adopters were often motivated by distrust of traditional financial institutions. The crisis also led to important changes in how credit rating agencies operate, though critics argue that these reforms have been insufficient to address the fundamental conflicts of interest that contributed to the crisis. New regulations required greater disclosure of rating methodologies and potential conflicts of interest. But the basic business model, where issuers pay for ratings, remained largely unchanged. Housing policy underwent significant changes after the crisis, with new regulations governing mortgage origination and servicing, designed to prevent the kinds of predatory lending practices that had contributed to the housing bubble. The Consumer Financial Protection Bureau was given significant authority over mortgage markets, and new rules required lenders to verify borrowers' ability to repay their loans, a basic principle that had been widely ignored during the boom years. However, many observers argue that fundamental problems in housing finance remain unresolved more than a decade after the crisis. Fannie Mae and Freddie Mac, the government-sponsored enterprises that played central roles in the mortgage market, remain in government conservatorship, with no clear plan for returning them to private ownership or replacing them with alternative institutions. The crisis had particularly severe effects on retirement security for millions of Americans, effects that continue to influence retirement planning and policy discussions today. Many workers saw their 401k accounts and other retirement savings decimated by falling stock and bond prices, with some losing 40, 50, or even 60% of their accumulated wealth in a matter of months. Those who were nearing retirement when the crisis hit were forced to make particularly difficult choices about whether to delay retirement, return to work, or dramatically reduce their standard of living. The defined benefit pension plans that had provided retirement security for previous generations of American workers were already in decline before the crisis. But the financial turmoil accelerated this trend, as many employers used the economic downturn as an opportunity to freeze or terminate their pension plans entirely. This shift of retirement risk from employers to individual workers was one of the most significant and lasting changes that emerged from the crisis period. The crisis also had profound effects on the insurance industry beyond the near collapse of AAG. Many life insurance companies and pension funds had invested heavily in mortgage-backed securities and suffered substantial losses that impaired their ability to meet their obligations to policyholders and beneficiaries. Some smaller insurance companies failed entirely, while others required financial assistance from state guarantee funds, or were forced to merge with stronger competitors. The commercial real estate market, while not the original source of the crisis, was severely affected as credit tightened and property values fell across most categories of commercial property. Many banks that had managed to avoid the worst effects of the residential mortgage crisis found themselves dealing with heavy losses on commercial real estate loans as office buildings, shopping centers, and other commercial properties lost value, and tenants defaulted on their leases. This secondary wave of commercial real estate problems extended the duration of financial stress in the banking system and contributed to the slow pace of economic recovery. Many regional and community banks that had limited exposure to residential mortgages found themselves in serious difficulty due to their commercial real estate lending, leading to hundreds of additional bank failures in the years following the acute phase of the crisis. Small businesses, which typically rely more heavily on bank lending than large corporations that can access capital markets directly, were particularly hard hit by the credit crunch that followed the financial crisis. Many viable small businesses were unable to obtain the financing they needed for normal operations, forcing them to lay off workers, reduce inventory, or close entirely. This contributed significantly to the severity and duration of the recession that followed the financial crisis. The crisis also accelerated existing trends toward industry consolidation in many sectors of the economy. Beyond financial services, weaker companies that might have survived during normal economic conditions were forced out of business or acquired by stronger competitors during the crisis. This consolidation had long-term effects on competition and market structure in many industries, potentially reducing competition and increasing market concentration in ways that persist. Today, agricultural communities experienced their own version of the financial crisis as commodity prices, which had reached record highs in early 2008, collapsed as global economic growth slowed and demand for agricultural products declined. Farmers who had taken on significant debt to expand their operations based on high commodity prices found themselves in severe financial distress when prices fell sharply and credit became more difficult to obtain. The crisis also had significant environmental implications that are often overlooked in discussions focused on its economic and financial effects. The economic downturn led to reduced industrial activity and lower energy consumption, temporarily reducing greenhouse gas emissions and other forms of pollution. However, the crisis also diverted political and economic resources away from long-term environmental challenges like climate change, as policymakers and businesses focused on immediate economic survival rather than longer-term sustainability. Issues. International development efforts were significantly affected by the crisis as wealthy countries reduced their foreign aid budgets in response to domestic fiscal pressures and economic difficulties. Developing countries faced reduced capital flows from private investors and lower prices for the commodities they exported, hampering their economic growth and development efforts. The crisis demonstrated how interconnected the global economy had become and how problems originating in developed countries could quickly spread to affect the world's poorest populations. The technology sector, while not directly involved in the mortgage crisis that triggered the broader financial collapse, was significantly affected by the economic downturn and credit crunch that followed. However, some technology companies were able to take advantage of the crisis by acquiring competitors at greatly reduced prices or gaining market share as businesses looked for ways to reduce costs through automation and efficiency improvements. Enabled by technology, the crisis also fundamentally changed the landscape of financial media and information dissemination in ways that continue to influence how financial news spreads and market sentiment is formed. Social media platforms, which were still relatively new and less influential in 2008, began to play larger roles in how financial information spread and how market sentiment was formed and amplified. The speed at which information, rumors, and panic could spread through these new digital channels added new dimensions to market volatility that regulators and market participants are still learning to understand and manage. Academic research into the causes and consequences of the crisis has continued for more than a decade since the acute phase ended, with scholars from economics, political science, sociology, history, and other disciplines offering different perspectives on what went wrong and how similar crises might be prevented in the future. This research has contributed to significant changes in how financial crises are understood and has influenced both regulatory policy and business practices in important ways. Legal proceedings related to the crisis continued for many years after the acute phase ended, though the results were often disappointing to those who sought accountability for the actions that caused the crisis. While few senior executives were criminally prosecuted for their roles in the crisis, civil lawsuits resulted in billions of dollars in settlements paid by major financial institutions to compensate investors, borrowers, and other parties who were harmed by fraudulent or deceptive practices. These legal settlements, while substantial in dollar terms, were often criticized as inadequate given the scale of the damage caused by the crisis and the profits that had been earned during the boom years. Many of the settlements allowed financial institutions to resolve their legal liabilities without admitting wrongdoing, leaving questions about accountability and deterrence largely unresolved. The crisis also led to significant changes in corporate governance practices at financial institutions, though the effectiveness of these changes remains a subject of debate. Many banks revised their executive compensation practices to reduce incentives for excessive risk-taking, implementing measures such as longer vesting periods for bonuses, clawback provisions that allow companies to recover compensation if performance targets are not met, and greater emphasis on risk-adjusted performance measures. However, critics argue that many of these changes have been largely cosmetic and that fundamental problems with incentive structures in the financial industry remain unresolved. Executive compensation levels at major financial institutions have largely returned to pre-crisis levels, and there are ongoing concerns about whether the industry has truly learned the lessons of the crisis, or simply found new ways to take risks, while socializing potential losses. Risk management practices at financial institutions were also significantly overhauled in response to the crisis, with many firms investing heavily in new risk management systems, hiring additional staff to monitor and control risks, and implementing more sophisticated stress testing and scenario analysis procedures. Many institutions also revised their risk appetite statements and established new governance structures to ensure that risk considerations are properly integrated into business decision-making processes. However, some observers question whether these improvements in risk management are sufficient to prevent future crises, or whether they simply represent efforts to fight the last war, rather than preparing for new and different types of risks. The complexity and interconnectedness of the modern financial system continue to create potential for systemic risks that may not be fully captured by traditional risk management approaches. The crisis highlighted the critical importance of financial literacy and the need for better consumer education about complex financial products and the risks they entail. Many borrowers who took out subprime mortgages during the housing boom did not fully understand the terms of their loans, the risks they were taking, or the potential consequences of default. This lack of understanding made them vulnerable to predatory lending practices and contributed to the severity of the crisis. In response to these concerns, various initiatives have been launched to improve financial education and literacy, though progress has been slow and uneven. The Consumer Financial Protection Bureau has made financial education a priority, and many states have implemented financial literacy requirements in their high school curricula. However, research suggests that traditional financial education approaches may be less effective than hoped, and there is ongoing debate about the best ways to help consumers make better financial decisions. Cultural changes also emerged from the crisis experience, particularly in terms of attitudes toward risk, debt, and consumption. The greed is good mentality that had characterized much of Wall Street culture in previous decades came under severe criticism during and after the crisis. Some financial professionals began questioning whether the industry's focus on short-term profits was sustainable or socially beneficial, though it remains unclear how deeply these cultural changes have penetrated the industry. The crisis also affected gender and diversity issues in the financial industry in complex ways. Some research suggested the financial institutions with more diverse leadership teams, particularly those with more women in senior positions, had performed better during the crisis and had been less likely to engage in the most risky behaviors that contributed to the problems. This research led to increased focus on diversity and inclusion efforts in the financial industry. Though progress in diversifying senior leadership positions has been frustratingly slow, international cooperation on financial regulation increased significantly after the crisis, as policymakers recognized that financial problems could spread rapidly across borders and that coordinated responses were essential for managing systemic risks. However, tensions also emerged as different countries pursued policies that were seen as attempts to export their problems to other nations or gain competitive advantages for their domestic financial institutions. The coordination that had been achieved during the most acute phase of the crisis proved difficult to maintain as economic conditions gradually improved and immediate threats receded. National interests began to reassert themselves, and there was some backsliding from the commitments to international cooperation that had been made during the height of the crisis. The European debt crisis that emerged in 2010 was closely related to the 2008 financial crisis, as many European banks that had suffered losses on US mortgage securities found themselves unable to support their home governments during subsequent fiscal crises. This created dangerous feedback loops where weak banks undermined government finances and weak governments threatened bank stability, leading to severe problems in countries like Greece, Ireland, Portugal, Spain, and Italy. Central bank independence, which had been a key principle of monetary policy in most developed countries for decades, came under increased political pressure after the crisis as these institutions took on expanded roles in financial stability and crisis management. The Federal Reserve's various emergency lending programs and bailout facilities during the crisis led to increased congressional scrutiny and calls for greater political oversight of central bank activities. The crisis also accelerated the development of financial technology, or fintech, as entrepreneurs and investors saw opportunities to improve upon the traditional financial system that had failed so dramatically. Online lending platforms, mobile payment systems, robo-advisors, and other financial innovations gained traction, partly as a result of reduced trust in traditional financial institutions and partly due to advances in technology that made new business models possible. Cryptocurrency and blockchain technology, while not direct responses to the 2008 crisis, gained popularity partly due to their promise of creating financial systems that would be less dependent on traditional banks and government oversight. The pseudonymous creator of Bitcoin, known as Satoshi Nakamoto, explicitly referenced the bank bailouts in the first Bitcoin block, suggesting that concerns about the traditional financial system were among the motivations for creating alternative forms of money and payment systems. The crisis also led to important changes in how credit rating agencies operate. though critics argue that these changes have been insufficient to address the fundamental conflicts of interest that contributed to the problems. New regulations required greater disclosure of rating methodologies and potential conflicts of interest, created liability for grossly negligent rating decisions, and established oversight mechanisms to monitor rating agency performance. However, the basic business model where issuers pay rating agencies for their ratings remained largely unchanged, preserving the fundamental conflict of interest that had contributed to the crisis. Some reform proposals called for alternative funding mechanisms, such as having investors pay for ratings or creating a public rating agency. But these ideas have not been implemented on a significant scale. Housing policy underwent significant changes after the crisis, with new regulations governing mortgage origination and servicing, designed to prevent the kinds of predatory lending practices that had contributed to the housing bubble. The Dodd-Frank Act included provisions requiring lenders to verify borrowers' ability to repay their loans and establishing new standards for qualified mortgages that would receive legal protections for lenders who followed the rules. The Consumer Financial Protection Bureau was given broad authority over mortgage markets and implemented new rules governing mortgage lending, servicing, and foreclosure processes. These rules were designed to ensure that borrowers received clearer information about their loans and had better protections against abusive practices by lenders and servicers. However, many fundamental problems in housing finance remain unresolved. More than a decade after the crisis, Fannie Mae and Freddie Mac, the government-sponsored enterprises that played central roles in the mortgage market, remain in government conservatorship with no clear plan for returning them to private ownership or replacing them with alternative institutions. This means that taxpayers continue to bear significant risks from the mortgage market. Despite various reform proposals that have been debated over the years, the crisis also had lasting effects on immigration patterns and labor mobility within the United States and internationally. High unemployment and limited economic opportunities in many parts of the country led to reduced internal migration as workers found fewer opportunities to move to new locations for better jobs. International immigration to the United States also declined during and after the crisis, and there was even some reverse migration as foreign workers returned to their home countries where economic conditions were relatively better. These changes in migration patterns had long-term implications for demographic trends, labor market dynamics, and economic growth in different regions of the country. Areas that had historically attracted migrants for economic opportunities found themselves dealing with population stagnation or decline, while regions that had been sources of outmigration saw some stabilization in their populations. Educational institutions at all levels were significantly affected by the crisis as funding sources came under pressure and families faced increased financial constraints. State funding for public schools and universities declined as state governments dealt with reduced tax revenues and budget deficits. Many colleges and universities saw their endowments shrink dramatically, forcing them to cut programs, reduce staff, and limit financial aid for students. The crisis also accelerated existing trends toward higher student debt levels as families found it more difficult to pay for college expenses, and students were forced to borrow larger amounts to finance their education. The combination of higher borrowing needs and tighter credit markets made college financing more challenging for many families, potentially limiting access to higher education and increasing inequality of opportunity. The healthcare sector experienced complex effects from the crisis that varied across different parts of the industry and different populations. On one hand, economic hardship led many people to delay or forego medical care due to cost concerns, loss of health insurance coverage, or general financial stress. This had negative effects on public health outcomes and created additional burdens for emergency rooms and safety net healthcare providers. On the other hand, the crisis may have accelerated some trends toward healthcare reform by highlighting the economic and social costs of having large numbers of uninsured Americans. The economic arguments for healthcare reform became more compelling during the crisis as policymakers and employers grappled with the costs of providing healthcare coverage and the economic drag created by having workers tied to jobs primarily for health insurance benefits. Infrastructure investment, which many economists argued was desperately needed to support long-term economic growth and competitiveness, became a casualty of the fiscal pressures created by the crisis. Federal, state, and local governments faced severe budget constraints that limited their ability to invest in roads, bridges, broadband networks, water systems, and other critical infrastructure. The American Society of Civil Engineers estimated that the United States faced a multi-trillion-dollar infrastructure investment deficit that was made worse by the budget pressures created by the crisis. The inability to invest adequately in infrastructure during and after the crisis has had lasting negative effects on economic productivity and competitiveness that continue to influence policy debates today. The crisis also significantly affected charitable giving and non-profit organizations, as donors faced their own financial pressures and endowments declined in value. Many charitable organizations were forced to reduce their activities, cut staff, or merge with other organizations to survive the economic downturn. This was particularly problematic because the need for charitable services increased during the crisis as more families faced unemployment, foreclosure, and other economic hardships. Research and development spending by private companies declined during the crisis as firms focused on short-term survival rather than long-term innovation and growth. However, government spending on research through agencies like the National Science Foundation, the National Institutes of Health, and the Department of Energy helped partially offset these private sector cuts through stimulus spending and other programs. The crisis had significant effects on family formation and demographic trends that continue to influence American society today. Marriage rates declined and birth rates fell as young adults delayed major life decisions due to economic uncertainty and reduced financial resources. These demographic changes have had long-term implications for economic growth, consumer spending patterns, and the sustainability of social insurance programs like Social Security and Medicare. Regional economic differences became more pronounced after the crisis, with some areas of the country recovering much more quickly than others. Cities and regions with diversified economies, strong educational institutions, and growing technology sectors generally fared better than those heavily dependent on manufacturing, natural resources, or other industries that were severely affected by the recession. This uneven recovery contributed to increased political polarization and regional tensions that continue to influence American politics today. Areas that experienced prolonged economic difficulties became more receptive to populist political messages, while regions that recovered more quickly maintained greater confidence in existing economic and political institutions. The crisis also highlighted the growing importance of global supply chains and international trade in the modern economy. As credit tightened and economic activity slowed, many companies discovered vulnerabilities in their supply chains that they had not previously recognized or adequately planned for. This led to some reshoring of manufacturing activities and greater attention to supply chain resilience and diversification. Labor unions, which had already been declining in membership and influence for decades before the crisis, faced additional challenges as employers used the economic downturn to extract concessions on wages, benefits, and working conditions. Public sector unions faced particular pressure as state and local governments struggled with budget deficits and taxpayer resistance to higher taxes or borrowing. The crisis also affected social mobility and perceptions of the American dream more broadly. The traditional pathways to middle-class prosperity, home ownership, stable employment with good benefits, and reliable retirement savings all came under severe stress during the crisis. This contributed to growing concerns about increasing inequality and declining economic mobility that have become central themes in American political discourse. Mental health effects of the crisis were significant but often underreported in discussions, focused on economic and financial impacts. The stress, anxiety, and depression associated with unemployment, foreclosure, and financial hardship led to increased rates of mental health problems, substance abuse, and suicide. These effects were particularly pronounced among middle-aged men who had previously enjoyed stable employment and economic security but found themselves unemployed or underemployed for extended periods. The crisis also revealed important weaknesses in the social safety net that had been designed primarily for shorter-term economic downturns, rather than the prolonged period of high unemployment and economic hardship that followed the financial crisis. Unemployment insurance systems, food assistance programs, and other safety net programs were overwhelmed by the scale and duration of need created by the crisis. The 2008 financial crisis stands as one of the most significant and transformative economic events in modern history, fundamentally reshaping not only the American financial system but the entire global economy in ways that continue to reverberate today. From its origins in the seemingly innocent policy goal of expanding home ownership to low-income families, to its devastating conclusion that brought the world to the brink of another Great Depression. This crisis revealed the profound dangers of unchecked greed, regulatory failure, and the complex interconnections that define modern finance. The human cost was truly immeasurable. Millions of families lost their homes, their jobs, their life savings, and their fundamental faith in the institutions and systems that were supposed to protect and serve them. Entire communities were devastated by waves of foreclosures and unemployment, while the dreams and aspirations of countless individuals were shattered by forces largely beyond their control or understanding. While we have implemented various reforms and safeguards in the years since the crisis, many of the fundamental questions it raised about the proper role of government in the economy, the responsibilities of financial institutions to society, and the delicate balance between innovation and stability remain as relevant and contentious today as they were during those dark days in 2008. The lessons learned from this crisis continue to shape economic policy, financial regulation, and political discourse around the world, serving as a constant reminder that the pursuit of short-term profits without adequate consideration of long-term risks and social consequences can have devastating effects that extend far beyond Wall Street trading floors to touch the lives of ordinary people in every corner of the globe. As we reflect on this pivotal chapter in economic history, we must remember not just the technical details of mortgage-backed securities, credit default swaps, and regulatory failures, but the human faces behind the statistics, the families who lost their homes to predatory lending, The workers who lost their jobs to corporate failures, the retirees who saw their life savings evaporate, and the communities that were torn apart by economic forces they never fully understood but were powerless to resist. The 2008 financial crisis serves as both a warning about the dangers of financial excess and a testament to the resilience of ordinary people who, despite losing so much, found ways to rebuild their lives and communities in its aftermath. Good night.